this webinar. So this webinar hosted by Dragon Argent in collaboration with BABR, a business recovery and insolvency practice. So today we'll be talking about how to protect your business from financial difficulties, exploring about how to identify them, cash flow management, and possible refinancing options. And in the unfortunate circumstances where things don't work out, we then will look at the practical perspectives of restructuring and possible insolvency and the different processes involved. So on the panel today will be myself. I'm Yao. I'm the head of corporate commercial here at Dragon Argent. Also with me is my colleague Harry Hassler, who is the head of accountancy. On the call is Tom Ahmed, who is a licensed insolvency practitioner. He'll be joined by Steve Broom. He's head of corporate commercial finance. So from here, we'll take questions along the way. Please, if you do have any questions, feel free to type them in the question box. We'll try and answer them at the end of the webinar. If not, we don't have time, we'll definitely come back to you after the webinar via email and answer any queries that you may have. So first off, I will start by the first question is talking about how to identify financial distress. So I'll open this up to Harry and Tom. So I think the first question most people would ask is, what are common early signs of, or warning signs really, of financial distress that business owners should be looking at or may often overlook?
I mean, Harry, as an accountant, do you want to start at the sort of the early stage, and I can sort of lean in from an insolvency practitioner's perspective? So I'll let you open up on that one.
Sure. Okay. I mean, the very obvious ones are cash reserves decreasing alongside liabilities increasing. Typically, we see, the time taken to pay suppliers just go up, and cash go down at the same time. Alongside that, we can see, it's taking longer for customers to pay our clients as well, which both those things together then impact the cash conversion cycle. So the difference between the age payable days and the age receivable days is the cash conversion cycle. So if that's lower than normal or even a negative position, then that's a sign of distress. We often see clients sort of using HMRC liabilities to sort of almost cash flow their business as well. So if a client's paying their usual suppliers just to keep the operations of the business running, but actually they're then not paying HMRC, their VAT, their PAYE, or the corporation tax, they're incurring penalties and interest, and really that cash they're using to pay their suppliers should have been used to pay taxes rather than their suppliers.
Yeah, I think it's very, very similar. I think ultimately most business owners have an instinct of things not working out. They run their business, they're very close to it. When you've got people that are paying later, when your customers are declining, when your pipeline of possible work, depending on the type of business you have, I guess when footfall's lower, if it's a retail scenario, these things are all indicators that there's a problem. Most businesses will adapt and improvise early on. They'll take action to try and rectify it. If someone's not paying you on time, you'll chase them up. If you're looking at trying to get more interest with the customers, you might do promotions or increase your sales activity. But ultimately, when signs of distress are often those sort of small things that build up that really result in the cash balance dwindling, you hitting the end of your overdraft. The bigger things that we see though are kind of those the more severe signs of distress are creditors pressing. When you're so late with paying your suppliers, when you are falling so behind with the revenue, and the cash isn't there, people start sending you chaser letters, debt recovery action, threatening letters. And at the extreme end, we see things like winding up petitions or threats of. Those are kind of obvious signs. There are other things though, just the day-to-day. You might lose key members of staff. You might lose a major contract. You might just not be on top of your numbers as well. That's another big challenge. I think I meet lots of directors that have sort of a vague understanding of where they are, but not a clear picture. And actually there are fine margins when things get tough. Also stress. If you are running a business, if your team and senior team are emotionally drained, fatigued, feel like you're under pressure. These are all signs that a business is not in a good place. So that's my take.
Sure. So just following on from that then, so are there any differentiations from sort of short-term temporary challenges to the more serious underlying issues? Are there any ways for owners to differentiate that? For both of you, open question.
I think the temporary ones are more specific and easy to identify. There are isolated instances that are not quite easy to rectify, whereas the more significant issues are much broader, just sort of sales reducing steadily over a period of 12 months. Could be, a market problem or just the client's reputation. But short-term, less significant ones are more easy to identify and resolve, I think, and isolate as well. Could be seasonal, for instance.
100%. So there are lots. So business is risky, right? And I think the whole context of this, and I think we don't talk enough about the kind of the endeavor of the entrepreneur who goes out in the marketplace. They have a view on what they want to achieve, but they aren't there and they work towards it. But they make that on the basis of a number of assumptions. But you could have a shop and there's suddenly a flood that hits, and the whole and the whole site is underwater, or you might lose a really critical member of your team. Ill health, one-off events that are clearly temporary, not in the normal course of business, that you can resolve or say we're going to get through this. It leaves a financial challenge, but you can kind of build going forward, or you have a strategy to deal with it. Underlying issues could be just the wrong business model. You have entered into a location or a market where you thought this was going to work and it isn't. We as professionals are going to see a world, and a lot of business is going to see a world where AI is coming on board. These are going to be fundamental shifts, and these aren't one-off events. These are going to be underlying things that we've got to adapt and improvise for. And we might find ourselves in the wrong place. Poor leadership, just fundamental change to the market environment where you can't get funding or support. These are more challenging to deal with and require some real thought. And again, you know what? I don't know. Whenever I deal with a director, when you start sort of unpicking, they know instantly. They go, look, if it wasn't for this one thing, we'd be okay. If it wasn't for that one thing, we'd be okay. When they're a bit lost I've tried everything, I just can't seem to make this work. Those are kind of fundamental underlying problems.
And then following on from that, then, so when a business owner gets that stage of identifying there are financial distress within the business, what typical steps should they be considering or should they be thinking about taking to sort of at that point?
Getting some financial reporting regularly, reports on the key metrics to safeguard their business, highlights key financial trends that might stop them from going down the wrong path, making sure that they're profitable. Once they've done that, they realise they're at sort of a cash flow problem, and they need to prioritise their liabilities and figure out which ones they need to pay first. Can they make payment plans? Can they spread payments across a term? Once they've done that, they then need to sort of communicate with key stakeholders. This is what our plan is. This is what we can afford to pay, and this is where we go from here. And obviously, cut non-essential costs as well wherever possible.
Yeah. Steve, welcome anyway. Steve has come along from a sort of commercial, my commercial finance colleague. I think the first thing a business owner needs to do is really, really simply realize they don't have all the answers and seek some support and help, and just really as a baseline, get on top of all the information they can to start making a decision, and also giving that information to advisors. So absolutely, Harry, all those things you've said, but if you don't know where you are with your numbers, you don't know, you're not clear on what your projections might be, what your assumptions are, your worries are, what you hope to do, just get all that distilled down and then get some help to kind of interpret that. And I would say you've got your accountant, you got your lawyer, you got insolvency practitioner, you got your friend who's an entrepreneur. You know, you've got friends and people outside of your space. You got Steve, your commercial finance broker that you know, and he's been supporting you. Get those people around the table with you, and also just be pretty vulnerable about it, because you don't have the answer. You're trying to find the facts, and good things come of it. But all the things that you've said, Harry, you know, are immediate steps to take, looking at your costs and all those things that come out of that data. Steve, have you got anything to add to that?
Well, as with often with these sorts of things, Tom, is, you know, engage as early as you can. Don't leave it to the last minute when the problem is potentially insurmountable. As soon as you think you've got problems on the horizon, start to engage, start to look at your numbers, start to talk to people like myself, and see what options you might have. And if you engage early, the options might be more productive than if you leave it to the last minute, when that may well fall into your world. Because obviously, if you run out of cash, that's not the best time. When you've got signs of distress showing in the business, that's not the best time to look at raising finance. So early engagement is always key with this sort of thing.
Yeah, just like seeing your GP when you feel like something's not quite. It's the same thing, right? It's difficult, and the reality is most of the entrepreneurs I deal are generally blokes, right? Generally rubbish at being vulnerable and have to pretend to be strong and great and network and market. But actually, you just need to get some private and confidential help, and just to check if there's something that can be done now.
No, so totally agree. So, and no, you've all picked up the point on, you know, collecting as much information and data that you've got about your business straight away and pulling it together. And that is where I guess the cash flow forecast and management comes in, and which leads on to the next section really about, you know, effective cash flow management and avoiding unnecessary pitfalls. So again, I'll open up to Harry first. Is, you know, what are key principles of effective cash flow management that people should know, business owners should prioritize? You know, what should they be looking at and considering?
Yeah, I think it's understanding the time lag difference between, you know, getting money in and getting them spending money, essentially. If your debtors are taking over a month to pay you, but you're paying suppliers within 30 days, you're harming yourself, you're harming your business. So you need to have some effective credit control, and try and reduce that time, and hopefully then marry up the two, so your cash, you know, isn't going out faster than it's coming in. Alongside that, you know, try to do cash flows regularly, as much as needed for the business, and try not to make them too long term. You do a cash flow forecast. Try and do a 13-week cash flow, so you're just focusing on the next quarter. That way you can be quite specific on what's going to be going in and out of the bank account over the next 3 months, rather than doing a 12-month picture, because you just can't be that accurate. It's too long term. Yeah, and other than that, you know, just try and shorten the amount of time for that cash comes in, and delay and spread payments where possible.
Yeah, I think, Steve, I mean, and sometimes that's just not possible, right? So the reality is that you're in a marketplace where you have to deal with that cost. But I mean, ultimately, when you get a lend in, it still make commercial sense to do the deal, but you just got to share some of that profitability with some of the financing, invoice financing options that are out there, or other, or overdraft or facility. But yeah, simply put, you know, you've got to pay for all the bits you need to do the job, and then wait for the money to come in, and it's always the profits right at the end, isn't it? And I think over the course of the year, we're working for everybody else. Probably the profit in any business is really paid right at the end of the cycle. Yeah.
Harry, you mentioned, you know, in terms of doing cash flow forecasts, not to do it for 12 and try it to 13. I mean, that sounds like it's a common mistake that a lot of business owners make. Are there any other typical mistakes that business owners make, and they should try and avoid, or, you know, any sort of key things that you suggest that they should try and do on top of, other than the 13-week forecast?
Yeah, I mean, we touched upon it earlier, but typically we see companies not paying HMRC when they should be, and then paying suppliers instead. So when we see clients, you know, using cash management tools effectively, they're separating out what's due to HMRC in another bank account. So they're changing their mentality that way. So I really emphasize that to people. You know, they should be transferring their VAT liability and their corporation tax liability across the year into a separate account. And then you've got actually just a bank balance of what you can use on operations. So that's a big one we see. And then the other one we see quite commonly as well is just like paying suppliers too earlier than they get cash in from their customers. If they think it's like a good thing to do and it gets a good reputation there with their suppliers, but sometimes it does harm the business as well. So it's just finding that balance.
Tom, are you seeing anything else when you come in when you're dealing with directors of companies as well? Any other sort of mistakes that tend to be made?
I suppose ultimately, I sort of go slightly high level. So I've been fortunate enough to do an accountancy. I'm a chartered accountant too, and I've done my insolvency exams, and I'm pretty articulate. A lot of the entrepreneurs I see are really good at their product and skill and delivery, but running a business and running all of those kind of decisions behind the scene are probably quite secondary to their natural skill set, low on the pecking order of what they want to do after a hard day's work. And so I think ultimately it's tasking someone with this work, and whether that's an accountant but an internal bookkeeper or someone in your business that is really good at just make sure bills are paid only when they're supposed to be paid, and that people are chased up early, and that you're pricing well as well. A lot of thing about cash is like, the other side about cash flow management is, are you paying the right amount for the things you need to run your business? Are you paying too much? Have you got too many things? So looking at those costs, and it's very easy, especially as a growing business. This isn't all about failing businesses, and I've experienced even in our own growth, and what appears to be successful on the outside is very expensive. You're reaching, you're doing new work, you're taking on new staff. There's a lot of skill and talent behind that, but if you don't apply the time in managing the money and the flow of money behind the scenes, which is easily forgotten when you're busy doing new stuff and growing, things fall away very quickly. And there are very fine margins with most SMEs. If you're carrying loads of cash and you're sitting on cash, then you're probably not trying hard enough. Most businesses will redeploy that cash, buying another site, more equipment, expanding, and then it goes very quickly. So I like what Harry said about putting aside a bit like your little Christmas fund, putting aside for those bills you don't want to pay, and then when it arrives, it's sort of done. Don't live out of your bank balance. Live out of your kind of your management information. But not much more to say really than that.
No, and obviously the whole purpose of doing these cash flow management and cash flow forecasts is to identify where periods of times where cash will be tight for companies. And then I suppose when at those points, we then looking at what other options are available. So for this next section, I'm going to open up to Steve to then ask the question. So where companies and business owners find they are tight for cash, what typical solutions or refinance solutions are there for business owners in those periods of times, really? So what's available out there right now?
Yeah, okay, thanks. I mean, typically, I guess historically, we would have seen businesses looking at overdraft facilities, which are great as long as you've arranged them ahead of the time that you need them. Most high street lenders now will want to be secured, so it means like second charges on properties. And again, if you've had the foresight to arrange it when the times are good, that's the best time to arrange an overdraft facility. But obviously, you pay a cost. They're not particularly flexible. They're not a scalable product. And to say that they're not a popular facility that high street banks want to offer much nowadays. I tend to do more loans for people, so you get a lump sum with a cash injection into the business and then monthly repayments. These can be secured or unsecured depending on the performance and trading history of the business. I also do quite a bit of bridging finance where businesses have got a short-term need and they see better times ahead, and that's a good product as long as there is a clearly identifiable exit. So just looked at one recently where it was part of the ISG issue, so they lost a lot of work, but they knew they had a big contract coming in 3 or 4 months time, so a bridging option got them through the 3 or 4 months where they couldn't afford to pay anything, and then once they were into the new contract, they could then afford to repay it. So bridging is an option as well sometimes. More popular now are the invoice discounting routes. So you can do factoring, disclosed discounting, or non-disclosed discounting, and that's just where your ledger, your invoices are used as the security of the facility, and they'll allow you to draw typically 60, 70%, 80% against your invoices, and then once your invoices are paid, the facility goes back down. So it's a kind of revolving credit facility. That's scalable product as well. So if you have an increase in business and your invoicing increases as a result, then the facility can be increased in line with your requirements and give you instant cash into the business. So it's a really useful product, and it's more about your client base than your business performance. So even if your business is struggling profitability wise, but you have a really good client base, then invoice discounting can still be a really good option for clients for that sort of funding requirement. Sitting alongside that is a revolving credit facility, which is a really good product. I'm a big fan of revolving credit facilities. Less admin than an invoice discounting. It will just give you access to a percentage of your overall ledger at any given time. So if your ledger runs at 1 million, they'll say give you 70% of that. So at any given point, if your ledger's 1 million, you can draw 700,000 against it. If your ledger increases, so does your drawdown ability. And again, if it comes down again because you're receiving cash into the business, then your ledger will come down and your access to drawdown will come down as well. Revolving credit facilities can be secured externally on property as well, or internally on the ledger, depending on the nature of the business. But it's a really good product for businesses to look at if they need flexibility in their funding requirements. But those are pretty much the main ones there. As I say, I've really seen high street banks moving away from overdraft facilities and using the ledgers as the security for any drawdowns. There are some specialist lenders out there. So if you've got clients that are in the construction sector, use payment on application rather than invoices. There's specialist lenders that will help those sorts of clients as well. And it's quite a competitive market. There's lots of lenders out there, and that's where I come in, is to help you navigate through the lenders and find the right lender for your business and the right structure for the product.
So when it comes to refinancing, Steve, so what sort of factors should they be considering which product is better for them?
Just need to sit down and have a look and see what's available. If it's a really short-term requirement, some of the unsecured funders, if the business has been trading well and not showing any kind of recent signs of cash distress, if you need a quick hit, really kind of quickly, happy to pay a little bit more because it's not the cheapest lending, then some of the unsecured lenders can turn a loan around in a couple of weeks. More often security is required, so it does mean that the lead-in time for these facilities is extended considerably if there's any security required. And this is why, again, it's so important to engage early, because if you have the ability to offer security for a loan, but you need the money in 2 weeks, it's not gonna come through quickly. You need to be really prepared and have these facilities in place in plenty of time if that's the route that you're taking down. I mean, invoice discounting can be a lot quicker, and again, if you've got a ledger with a good strong client base, that's a much quicker route to go, and a much easier route with less onerous in terms of giving security for it.
So I mean, one thing I've observed alongside you, Steve, is that there's a few things. One, a business may have funding in place and everything's fine until the funders decide they don't want to do this anymore, or the bank decides that they're not really interested in that market, and that's happened. There's been shifts in appetite, especially with some of the older banks taking different views on what they want to do. So that can leave clients needing to shop around and think again, and that tends to be the trigger when they probably could have got a better deal or considered their financing, a bit like our electricity at home. You only do it when you really need to. The second thing I've noticed is that ability to mix. So sometimes it's not just one product. When you take a whole business view, you look at where they are today, where they want to be, and ultimately what it will take financially to achieve those things, and when. It can be a real mix of facilities. I don't know if the term is syndicated, putting things together so that they get everything that they need in the right way for the moment that they're at.
Yeah, no, it can be across a suite of products, and sometimes just different lenders, putting different elements out to different lenders where there is appetite, depending on how complex the business needs are. Yeah, sometimes it could be a case of doing some in a secured lend with one bank and his invoice discount facility with another bank. And again, you just look for the best deal with the particular lender to give the client the best outcome.
So from what you're saying, it's probably, in that sense, it's probably not to put all your eggs into one basket, really, and try and avoid being, held up by one particular financing company or refinance or bank as such.
It depends. It really does depend, because if you find a really good lender that will do all of the facilities that are required at the best rates, then you go with those ones. But sometimes you get someone that will do a really good deal on invoice discounting because that's their expertise, but they won't want to do a secured loan. So if you've got a client that needs a bit of both, then we would look to take the secured loan to the bank that will give us the best deal for that element of it, and the invoice discounting again to the specialist lender that will give us the best deal for that element of it. However, if you can find one lender that will do all of it, then that's great. That's always a great route to go, because sometimes with lenders, having more of your eggs in that basket can actually be beneficial.
And just behind all of this, and we've been here before, Steve. You're only going to get a lend if you've got a good underlying business plan. You've got the information. You know where you know what it's there for. So we have been in scenarios where people will tend to approach for extra financing money where actually they're just not financeable. The business is in distress. It's not the right thing. It potentially is going to throw good money after bad. A scenario where, well, they need £500,000 but they can only raise 200,000, say. Well, that's just not going to solve the problem. That's just kicking it down the road. And then if that director has signed a personal guarantee, put their property, their home on them, signed up for that, they're really exposing themselves to real risk. And Steve, will be minded to say, do you know what? Is this right for you? I know it gets you over this short window. These things have to have a reasonable chance of, being paid back and being good for the business and its owners.
Yeah, the business has to be viable, and I'll always work with accountants as well to say, look, if we can raise finance, and in that scenario where the business is showing signs of distress, it's always going to be secured, so they are going to have to put assets on the line, and that's when I will have a conversation with the accountant and the client to say, look, you need to prepare cash flows, demonstrate that this cash injection gets the business where it needs to be and can sustain any other little knocks that come along the way, because as you say, Tom, it can be a case of throwing good money after bad, and you're just making the problem worse in 6 months' time.
The flip side, is that sometimes that what they can borrow, say personally, or put in essentially, which is their money when they're putting their homes, they're sort of personally lending this. So let's not beat around the bush really. It may well be enough to fund a restart or a reset of the business following an insolvency process, as opposed to rescuing a company with a historic debt burden, something that's fundamental. Again, there's real value in thinking it holistically, but you only get to the answer in these are very bespoke scenarios when you're speaking to a mix of advisors around the table.
And again, you can't stress enough the importance of early engagement. The options will be better and more variable if you've got the time to deal with it properly.
Okay, we've just had a question come in. I think it's about something about earlier. So they wanted to just know the different timescales you would hope business owners see a business preparing for cash flows for. I believe we said it was 13 weeks.
Yeah, we recommend a 13-week cash flow because that takes you to the next quarter, essentially, 3 months.
Are there any circumstances where you say it should be shorter, or it's okay to do longer?
We would normally just say 13 weeks for like a business in distress, because that will plot out 3 months payroll and liabilities that are due over the next quarter. If you're doing it for longer, it's going to be more high level, more of a high level forecast for management and planning rather than for navigating through distress.
I think it's like everything. You've got the high level long term view and what we're trying to achieve, because the other thing is this, whilst we're looking short term to survive, this is an investment of people's time and energy as well as anything else, so whilst you're getting through a survival stage, is that going to lead you to a place where you could then get to a point of turning things around? So I think the high level view has to be considered, but you drill it right down to that rolling short term view. To make sure that you're not making the position worse. I think one of the biggest things that really needs to happen when things are deteriorating is that you stabilise that and you try and at least keep it where it is. If it gets worse and worse and worse, that's when directors are going to be potentially criticised, because you're going to hit a failure at some point. The wheels are going to come off at some point. And that's well, you should have known that 2 or 3 months ago. So yeah, I think it's that mix.
No, and I think, like you say, the idea is obviously to identify when cash is coming in and when your customers or some people are paying you in. So, which obviously in business things happen, and people aren't going to pay within the credit period that you agreed or whatever's invoiced, which leads to obviously then debt recovery and collection. So again, I'm opening questions to maybe Harry first, and then Tom and Steve. Is so what collective strategies have proven to be effective in today's environment, and in terms of debt recovery, collections, and how can business owners tailor them to their specific needs?
Yeah, so we use Xero as an accounting platform. Most accounting platforms, cloud ones will let you do this as well. So adding payment links to invoices you send directly from the accounting software is a good way just to try and cash in quicker. You can then set automatic reminders from Xero. It's a very basic step to try and nudge your clients to pay you. What we see work best is, there's very generic templates in the accounting platforms, but personalizing those to how you would normally talk to a client and communicate with them is definitely a way to go. Trying to get the right tone, firm but friendly. And then adding on to that as well, you can add like Stripe and GoCardless as payment terms, setting up direct debits, coming in regular services is a good one as well.
Yeah, I mean, and again, just sort of tracking back as well, just slightly before that, a good debt recovery starts with just knowing your clients and your segment and the people you're dealing with, and where you sit in that cycle. So there's a lot of technology, I think, in terms of understanding debt behavior, industry sector analysis, knowledge around that, risk profiling customers. Again, it depends on the scale of your business and to the extent you can do that, and seasonality as well and all those things. But 100%, it's putting in some basic processes and automations to ultimately, it's people behind this, right? So the person that you're dealing with is trying to manage their cash flow, all of the systems aside. And that person will prioritize the people that will shout the loudest, be most important, be most assertive. And your skill, or the skill of collections, is to just be on the front foot on that with your communications and reminders. Don't give them the opportunity to forget and then spend the money elsewhere, and then you're in a queue. So yeah, all of those sort of automations. And if it's a more sophisticated business, and certainly for the credit control stuff we're doing, it becomes bigger. Make sure you've got an appropriate resource. There's got to be a person here. So if it's a part-time person that isn't keeping up, that isn't doing that, there is some really sophisticated automations that we as our debt recovery business has built for more sophisticated credit control processes, where there's escalation and it goes up the chain all the way through to enforcement. So having them in place sets a signal to people that do business with you. You'll do a great job, you'll do a great service, I'll deliver it, but I expect to be paid on time.
No. And is there any benefits, I guess, in getting a third-party agency to do the debt recovery for you, as opposed to you doing it yourself?
Because like anything, outsourcing is going to save you time to help you grow your business, rather than you sort of worrying about the cash cycle. Getting someone else to do it and paying a fee is going to be beneficial to the founder, the business owner, to go out and grow.
Yeah, it generally isn't core to a business. So if your business is collecting in debts, then you should have a debt recovery business, right? So and that is it, but it is a core skill. As you grow, you hit these brick walls in your business of areas of weakness or expertise, and outsourcing, you're getting the expertise at a fraction of the cost, because you don't have to hire a experienced debt recovery person to work 5 days a week. You can kind of access it fractionally. The payment options might be different, so you can shop around as well. So there are those things. I have to say, sometimes just having someone else dealing with a debt collection outside of your business, a third party signaling, when you do some preamble, and even those third parties can pretend to be you for a bit and then be themselves, can be enough to make people go, oh, this is getting serious now. It's a new person. Access to better systems, processes, staff, I think, and also a network. So a collection specialist will work with solicitors, insolvency practitioners, a number of people, so you have suddenly straight access to them with advice around how to approach a particular debt or debtor. So there's a lot of benefits there. And you can agree protocols with them, so they can, you know, they if you want them to be ethical, right? So I'm going to take an ethical point of view. Pick ethical debt collectors that can be very firm but ethical through the process. So there's some of the advantages.
And I think one thing, and there's another key point, it's probably a people thing, is I notice a lot of business owners don't like confrontations. It's one of those where they want to continue that relationship with that particular customer, but don't want to end up in a confrontational position where it sort of destroys their relationship, and they realize that's it, that would be the end of that sort of customer relationship with them if they get too confrontational about any debt recovery. So they outsource it to a third party, so they can then say, well, it's not me, it's them, they're doing it, and we have to do it from an objective basis, as opposed to getting really personal with things. So hopefully it puts that bit of gap between you and the customer, and therefore it hopefully allows that relationship to continue once the debt is recovered, I guess, is one of the other key points that people tend to use third party agencies.
Yeah, and sometimes it can be no win, no fee. A lot of our stuff that we do is only on contingency fee basis, depending on the nature of the debts as well. You don't have to outsource everything. You can outsource specific debts at a certain escalation point as well. Beneficial. So yeah, 100%.
So we just had another question come in, and the question is, would you recommend being upfront with customers to explain that you use a debt recovery business as part of your process, slightly in a more cheerful way, or does that sort of give the game away too early?
No, I guess it's all about open communication, right? And I know, so if you work with someone, you're providing a service and you agree payment terms, I think it's reasonable to say at the beginning, I'm going to do this and I expect to be paid in 30, 60, 90 days. I think it's appropriate to remind them, hey, hope the service is all right. You do all those things. We've made payment easy. Ultimately, what you'll find is that in your escalation process, there's got to be at some point a conversation around, well, this is now late. We're going to escalate. We're going to try and enforce this debt. I think it's probably appropriate to say we work with, and I wouldn't use debt collection. Maybe you could say we have a credit control. We have outsourced credit control, which is helping us manage our cash flow, and that's what we run as a business for those people that are late payers or don't pay. We'll enforce those debts. Because if I don't get paid by that customer, I might not be able to do the work for you. That's the truth, isn't it? And a lot of businesses are relying on the cash from before. Steve, I mean, do you see any, I don't think there's any controversial to say.
With that, I wouldn't put it at the outset, because you might find that 75% of your customers pay anyway, so you're kind of flagging it unnecessarily. But I think there will come a time with any client relationship where you question, is it a good client relationship at all? And at that point, I think it's time to be very clear about the steps that you will take to get paid the money that you're owed. But I wouldn't certainly do it at the outset, because hopefully a lot of your clients will pay, and no problems with them at all.
Agreed.
Thanks for that question. So I suppose, so far we were talking about, things about what we can do when we have financial difficulties, a way to get out of it, and obviously to keep the business company. Inevitably, there'll be times where, unfortunately, it just doesn't work out, and the company then becomes into serious financial difficulties. And therefore, we're then looking at the potential issues of insolvency of the company. So I'll open this question first up to you then, Tom, is in that situation, what should businesses prioritize when it comes to when they get to that position, and when looking at entering into insolvency proceedings?
Okay, so I'm going to assume a couple of things. All the stuff we said before, you've got your information together, you're getting advice from proper professionals, people that are licensed, regulated, appropriate insolvency practitioners, your accountant, your lawyers, all the professional advisors around you. When a business is in distress, obviously, as a business owner myself, it's quite an emotive thing. That's the first thing. So you've got to try and keep some of the emotion a little bit out of the decision-making process. The businesses, every decision you make has to really be in the interest of the company. I'm going to assume a company here, but assume of the trading entity, its creditors, the people that are owed money. So it obviously has this historic debt, and you've got things that are called fiduciary duties, right? I guess ultimately duties that are bestowed upon you as a director to be reasonable, fair dealings, open, honest, all of those sorts of things. So that's the first thing. I think you need to be thinking not about your own personal interests. You need to be thinking in the context of the company and its creditors, and that frames a lot of your decision-making process, being fair. Second thing is there's a term called wrongful trading, which is continuing to trade when you knew or ought to have known that the company was insolvent, and you almost make the position worse. So ignoring the issues there, just maybe increasing your credit terms, borrowing more money, just being a bit reckless, signing up new customers. I've had at the extreme, I've had a director who converted camper vans into camper vans. He ran out of cash, so he showed the same van to 3 customers, pretending it was theirs. Just to try and keep going, to take deposits, to try and get through. Just ridiculous behaviour. But you got to think, you're harming more people. People will expect you to take advice. They'll expect you to get on top of your numbers, and try not to put your head in the sand and delay. So take those decisions with that help. I think that's the first stage, and then really in terms of being open and you've got to be realistic about the future, which can be hard, and that is getting balanced ideas. But you've also got to be open with your commitments. You've got to be careful about your communication strategy with stakeholders with all of this. But when facing distress, there will be, if you do eventually fail, if you don't recover, which is a real risk here, that the company ends up failing, there will be scrutiny over what you've done in that period leading up to the company's failure. And so by working with advisors and doing what they say with their advice, you're providing yourself with some protection as a business owner.
No, totally agree. And I think I agree the point regarding, separating yourself from the business. I think for a lot of business owners, they see the business as them, and therefore become very emotional and very personal when they see the business unfortunately starting to fail, and not accepting that it's probably now time to maybe think about cutting a loss, or looking at things to bring the business to an end, and considering next steps from there. So just I'm conscious of time, so the next bit unfortunately will be probably a bit brief and whiz through, but hopefully we'll try and cover as much as we can. So Tom, from your perspective then, any common missteps that you've seen when speaking to business owners putting their business into recovery, and what they can do to mitigate that?
Well, on time, I think it's all the stuff I said before, not doing what we've just said. Yeah, so that's the common misstep, not being on top of your numbers. And it's okay to be late, right? It's okay to not have your homework ready. I also want to talk to a lot of business, and I don't know about you, Steve, but even in dealing with finance or anything, it's actually quite rare that everyone has everything that you need in the first moment you talk to them. They know the problem that they've got to solve. I need some money, Steve. But so, even just starting the process is critical, and don't feel that you've got to be perfect before you see a professional. just turn up with as much as you can, and we can start solving the problem. And also, we'll often bring the accountant in the room or whoever. Agree, Steve? You say?
Yeah, definitely. Yeah, I mean, we wouldn't expect people to know the solutions and what the outcomes could potentially be and what their options are. We just need somebody to identify that they're heading for a problem, and then let the experts, let the people that can advise them accordingly pick up and do some work with them and look at what the solutions can be put in front of them.
Yeah. After that, it's when you've agreed what we need to do. The second common pitfall is not acting, because it's hard. But I have sympathy for that. And I do get a business is someone's baby, and I do get that, you know, us professionals from the outside in, yeah, we're not the ones that have had the sleepless nights for the last 6 months. Our house is on the market, you know, we're not the one that worried about paying other people's mortgages before our own. So I have massive sympathy for that. But just crack on and turn up with the help you get.
So, as you said, we turn up, business owners in that situation turn up to you, speak to you, speak to us, and as lawyers, to the accountants, to you as insolvency practitioners. I suppose it's like, when they're ready to make that formal step, then how would they go? What's the process for appointing you as the insolvency practitioner for their company?
Yeah. So I guess it depends on the solution. The first thing is, a lot of these things start with a consultation, all those things. So I don't want this to be too salesy, but what are we trying to do? Often we're trying to look at the options to recover and rescue. So from personal experience, so that scenario that Steve talked about, a refinance to get to another contract, a substantial contract, but there was a huge delay, and the company they were dealing with went into administration, and they had a massive one-off cash flow here. But that came to me as an inquiry about a business that is going to run out of money next month, right? And there's no way it can survive. The first conversations were very much around what is the underlying business, what's the event, and it became clear that actually it wasn't an insolvency, it was possibly a refinance opportunity. And that ended up being a very informal arrangement, brokerage scenario, look at the options. They had some decisions to make, but it was something that was right for them. So that engagement process is making sure they go and deal with the right advisor in the right way. Sometimes the engagement process comes from a referring accountant, quite often, yet the referring accountant hasn't been given the information to give me the information I need to understand what's going on. So it may well be me saying, look, before we even have a chat, if we've got the time, if you come in earlier, go back to your accountant, give them the information, pay for them, then we'll revisit. If we're looking, these are sort of turnaround scenarios. At the extremes, we might be looking at, actually the most extreme is that this is not viable anymore. There's underlying issues. Pandemic, you had a sandwich shop by an office block that now is only occupied Wednesday, Thursday, and Friday, or whatever. But the overheads, the fundamental, it just doesn't work anymore, and it will never work because people work in other locations. We may well look at a shutdown and a redeployment of talent and staff back into the economy. So the way I frame everything that we do is redeploying useful resources, people, energy back into the system in the right way. And sometimes that means, unfortunately, there's a loss, a structured wind down. The other things that we look at, again, is also, can we restart in some way and do a repackage, a pre-pack set restart of a business? And all the names you hear about, administration or CVAs or liquidation, these are all processes that are tools that we have. But the underlying aim for engaging with us, in my mind, is to make sure that decent, honourable entrepreneurs doing their best and have been reasonable have a chance to restart, whilst at the same time minimising the loss to those that are affected, because they're business owners, they're employees, they're stakeholders too. And I've very, very rarely ever seen a business owner who doesn't care about everybody else. There's this perception that, sometimes, dare I say it, from the revenue and the state, they sort of assume that sort of all business owners are doing. So I've lost the chain of your question, Yao, but ultimately,
No.
The engagement
No, that's
process is
fine.
very fluid depending on what's needed at the time and who needs to get engaged.
I think one thing I've noticed, I think I've just got two more questions for the webinar. I think first off, throughout here, we've always said reach out sooner rather than later. So I suppose the flip side is what happens if someone waits too late? If a business owner waits too late, what are the possible ramifications?
It's really simple. They've run out of money. So when so you know so they'll call me up and I don't know, Steve will say, you know, really simple. I can't pay the wages this week. I mean, the last thing that businesses don't want to pay, the last thing is the wages, because these are staff that turn up every day and they go, I don't know how to pay the wages at the end of the month. Now, if it's not their fault because they were expecting a substantial payment in and it's been delayed, it's promised, you know, you have some sympathy, but that's the reality. And when they can't pay the wages, their only option is to introduce personal money to pay the wages, which is if they've got it. It's too late to raise finance probably in the 11th hour, so it's personal money. And if they can't do that, then the right thing to do is it's a structured shutdown of a business. That's the reality. You can't ask staff to work tomorrow if you know that they're not going to get paid. It's just not fair. So what we end up doing is making staff redundant. We work on a structured liquidation. Voluntary is the best way. Speak to customers and clients, and it's really bad news. It's really tough. Similarly, if you've been under threat of action from creditors, you've ignored the letters, we get those calls. The revenue have been writing to us for weeks and months because you get the Harry, and then suddenly one day there's a winding up petition presented. They've ignored that, gets advertised, and then the bank accounts freeze because the banks are monitoring and they can't pay the bills. The sad thing about that is it's just, that's the end of that. So it's quite hard to start again, and it doesn't look great. So that's the extreme. We can still help people in those. We get people that come to us right at the 11th hour, but what we're doing then is going, okay, we're sorting this out now, is what it is. Let's try and do the best we can. And again, quite often, if they've not done this before and they do the right thing at the end, they can possibly look to restart or get a job. That's the aim, right? And get everyone moving forward. On a spectrum,
I was about to say, you've as you're finishing, I think that's pretty leads to a nice final question to me is, upon a business failure, you know, can business owners restart their business in a different guise, or you know, how would they do it?
So first things first, business is risky and businesses do fail. If they didn't, you're not probably trying hard enough as an economy, and you know, it's an experiment, but it's how you fail. So assuming genuine reasons for failure, everyone did the best they could, circumstances were what they were, and a director proactively engages with help and proactively engages with the shutdown, wind down process, whatever it looks like. Absolutely, you can be a director again, as long as you're not sort of taking advantage of a system or doing phoenixing and you've got a track record. There is a record of failure that companies has, because there's a company that's maybe gone into administration or liquidation. So people ask questions about what happened. Steve, how many, you know, every economic crash, right? You deal with entrepreneurs that make a lot of money for lots of people. The wheels come off. They lick their wings and they're entrepreneurial, and 2 or 3 years later, they're back in the game, aren't they?
Yeah, and some lenders take a very dim view if there's been a lot of losses and creditors and HMRC have not been paid out. There are others that will take a view on that, but they become slightly more expensive and the pricing goes up. But yeah, in a lot of cases, there are options. There are lenders that will still look at people that have had a few issues historically. They'll want to know why, and this is especially where if directors have not acted properly, that will obviously impact decisions going forward. But yeah, it's not insurmountable. There are lenders out there that will still support businesses in a restart situation, and directors that have had problems in the past.
And just finally, often it makes good sense to get directors involved. If they're genuine, they often have an intrinsic knowledge. They can set up a restart, they can preserve jobs, they can sometimes preserve customer relationships. They're often quite keen to finish work, even at a loss, just to do the best they can. and they kick back into the economy taxes and profit for the future. Sometimes in a restart, a fresh model. My analogy, it's like driving. If you keep your nose clean, you have a bump, your insurance premium goes up, you can kind of start again. If every week you're wrecking a car and you're drink driving and you're reckless, you're going to get banged up. It's not so. Yeah. It is that. Don't take the business failure lightly. Don't fear it though. It's part of the process, and the best entrepreneurs come away more knowledgeable, learn something about themselves, learn something about what they needed as part of their growth plan, and are a lot less likely to make the same mistake again, if indeed it's something they could have foreseen.
Perfect. I think that's probably the nicest place to end the webinar. So thank you for everyone who's attended. We do apologise for the beginning technical issues, but hopefully everyone is able to get most of the information from the webinar. We are open for questions. If anyone has any further questions, feel free to email them into us, and we'll be happy to respond to you via email after the event. But thank you everyone for attending.